Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I thought I would record this special episode this morning. The goal of this podcast is to really focus on fundamental evidence-based strategies or insights to help people make good long-term decisions. So I tend to not get dragged into the news of the day. However, I wanted to record this episode about the tariffs that the US government has announced, or President Trump has announced, because and then relate it to the long-term fundamentals and what sort of approach I would encourage investors to take. And I think it's just an example of how to apply these long-term principles, if you like. So, I mean, you would have to be living under a rock to not heard of the tariffs. President Trump has increased the average tariff from 2.5% to 22%. And to date, the US market fell 5% on Thursday and about 5% on Friday. So about 10% in total. The Australian market fared much better, fell about 3% over those 2 days, although looking at the futures at the moment, it might lose another 3% today, but still a little bit better than the US. I mean, some of the tech companies have fallen significantly. Apple, for example, fell 17%, lost 1 trillion Australian dollars in value, which is about a third of the entire ASX, just one company in the US. So it's been carnage, really. And the way that the President Trump has calculated the tariffs is pretty interesting. So if you take China, for example, China sold about $400 billion of goods into the US in 2024, last calendar year. But China only bought about 130 billion of goods off the US. So the US has a trade deficit of 270 billion, so 400 minus the 130 they sold them. China is better off by $270 billion worth of goods. So if you divide the $270 billion or divide 270 by 400 billion, which is the goods that China sold into the US. So the deficit by the amount that's sold into the US, you get 67%, which is what Trump has called the tariff charge to the US. And so what he's done is just halve that amount and charge China 34%. And that's how he's worked out, what tariffs he thinks the US is being charged, and he'll halve that amount. So in simple terms, let's say I'm the US and you're China. I've bought $10 of goods off you, but you've only bought $3 of goods off me. So you're doing much better out of the relationship. So the difference is $7. Therefore, I'm going to charge you a tariff of $3.50. That's essentially the math, if you like. There's no real science behind it. In fact, there's no science at all behind it. But there it is. So let's think about if these tariffs are permanent, and I want to underline if these tariffs are permanent, what are the impact? Well, I mean, we'll see, but some of the impacts that are being spoken about at the moment is, higher cost of living for people in the US. So inflation, because the input prices have risen. It costs more for US manufacturers to buy and import some of the raw materials or components that they need to produce their goods and services. And as a result, it will need to rise. So I think that I've seen some commentary about McDonald's, for example. They import a lot of beef from Australia, for instance. They might have to put prices up 10% or something like that. It was spoken about. There'll be supply chain disruptions because, some manufacturers will go, well, we can't afford to import from Indonesia anymore with such a significant tariff. So, that's going to push prices higher too, just like what happened during the COVID period, where there was some supply chain disruptions. We're seeing what happens there. And it probably will result, if they are permanent, in a global recession because, the biggest developed country will go into recession just because cost of living is increased, but household incomes aren't necessarily increased. In other countries, it could mean lower inflation because some of those countries that would otherwise sell into the US might dump their goods at a much lower cost into other markets. They're going to have to sell them somewhere, so that could put downward pressure there. And then interest rates are likely to be lower, particularly if central banks are worried about a global recession, obviously to help countries through this period. So there's a lot going on, but of course we don't really know whether they're permanent. And Trump's approach typically is attack, attack, attack. Number two, deny any wrongdoing. And number three, claim victory either way. That tends to be his sort of three-pronged approach. And he's certainly doing it in this situation. You can see roll out all these tariffs across the board. It's very much attack, attack, attack. The problem, though, strategically, if you actually wanted to implement these tariffs long term, the problem with rolling them out all at once is that you incentivize countries to potentially work together that otherwise wouldn't necessarily work together. So it's really almost the rest of the world against the US at the moment, which strategy-wise isn't a great idea, of course. And so it makes me question, whether this is a tactic by Trump or whether he actually wants to roll these out. The other thing too, he's talked about, the amount of revenue it's going to raise. But, if you tax people at sort of 30, 40, 50, 60, 70%, they're going to do business elsewhere. So even if you go, well, there's a $270 billion trade deficit between the US and China. If we add 34% of that, it's going to raise a lot of revenue. The problem is the US won't be buying as much off China anymore if there's a 34% tariff. So that's not really going to work. The maths just aren't going to work if they are permanent. And the other thing too is I think if the market thought these tariffs were permanent, this is where it was going to land. I reckon markets would have dropped 20 or 30%, not 10%. So I think just because of the approach, the fact that it's been rolled out, globally all at one hit, which strategically isn't a great idea if you do want to actually implement higher tariffs, and the potential impact on the US economy, the negative impact on the US economy, I'm leaning towards this is merely just a tactic to either just negotiate better deals, whether it's to reduce trade deficits or maybe even reduce existing tariffs that are in place. I think if you come out with a really unpalatable option initially, then you can always negotiate back. And I'm starting to think that might be his idea. But of course, I'm not here to commentate on geopolitical matters or any of these sorts of things, and of course, completely apolitical in this podcast. It's really just trying to understand what is going on, and let's talk about, what impact it will have on your investments and what decisions should you make as a result. Investment decisions you should make as a result of this. And this is the key thing. This is why I wanted to sort of talk about or record this episode. So firstly, it's too soon to tell, what's going to happen, who the winners and losers are going to be. It's just too early days. You shouldn't be making any decisions or any changes at this stage, in my opinion, because nothing is clear yet. I mean, it's only just happened. We've also to maintain some perspective. Yes, the US market has lost 10% already. It means it's trading at the same levels around April 2024, so last year. So we've lost 12 months of growth, really. Let's not be too depressed about it. The market was already pretty high, and it's lost a little bit of that growth over the last 12 months. In this podcast, I've recorded several episodes over the last number of years saying we are underweight US and we're underweight large cap US. Now, the thing that creates the volatility is always different and always unexpected. And, you can argue whether we expected, Trump to roll out tariffs and to what extent, but, it spooked the market. And, that's always, the thing that spooks the market is always very difficult to predict. But one of the reasons why, if we're investing in companies or markets that are cheap and a volatility event occurs, well, arguably or theoretically, they should drop less than, say, markets that were already overpriced. And one of the reasons why we were underweight large cap, really weighting towards value, and underweight US overall. Probably the most interesting history to look back, and I talk about an evidence-based approach always in this podcast, is that if we look back in history, the times when the share market has dropped 5% a day for 2 consecutive days, so 10% in total, It happened in 2008, the GFC. It happened in 2020 during the COVID crisis, and it happened a couple of times in 1987 with that share market crash. In all of those times, so twice in 87, once in 2020 and once in 2008, the subsequent one-year returns after the 2 days of 5% falls range between 24 and 62%, the subsequent returns. And the 3 and 5 year returns are equally pretty attractive. So history tells us that the share market will drop about 10% on average every 2 years. This volatility isn't unusual. Also, the data shows us that the 12-month subsequent returns are always positive or have always been positive. Now, if you look at, in fact, drops of 9% or greater over a 2-day period, they too are all positive after 12 months. We don't know what the actual impact will be, the long-term impact. We don't know who the winners and losers will be. We've spoken about in this podcast before about, the risk in the market in terms of the large cap US stocks. So hopefully investors that have been listening to this podcast have made changes in that regard to reduce risk in their portfolio. And at the end of the day, we're long-term investors. So prices falling, if we're doing regular investing particularly, it's good. We can get to average down. We're investing at this stage at April 2024 levels. If it drops even further, it's a great opportunity just to invest more. And who cares what happens to the share market over the next 1 or 2 months? We are long-term investors. We're most interested in what's going to happen over 5 to 10 years. And therefore, our approach really should not change. So that's the answer, is that, look, there's a lot going on, but stick to your plan, stick to the long-term fundamentals, make decisions that are 10-year plus based, not really what's going to happen over the next 12 months or 6 months. And the actual potential upside here is, and for those that diversify across both shares and property, is that in my experience over the last 25 years, when there's greater volatility in the share market, the property market tends to do better. Like, investors will flock towards property and away from shares. And remember, shares have produced some great returns over the last 5 to 10 years. Whereas you look at the Melbourne and Sydney property market, not so much. Brisbane's done pretty well, and Perth and Adelaide have done okay as well. It all moves in cycles, of course, but high volatility in the share market is typically good for the property market. And if we do see lower interest rates, I note that the markets are pricing in almost 100% probability of rates being cut again here in Australia in May, and 2 more cuts at some point over the course of this calendar year. If interest rates come down, that will also stimulate property as well. And another reason why I think most investors will be well served by investing in both property and shares. So I just wanted to share my thoughts about what's been going on over the last few days, particularly in the US, and just encourage people to stay the course, play the long game, and stick to your long-term investment strategy. I might leave it there until tomorrow. Bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.